All right, today we are going to do a very important standard, a short standard, but again, it has its own importance in terms of financial reporting. So, events after the reporting period. Now, this is the standard which you have done in your F7 exam. Even you have discussed this thing in your F3 exam. So, you have some knowledge regarding it. You discuss something regarding this in your audit paper, F8 paper. So you have some information regarding this standard, events after the reporting period. Now reporting period means reporting date, or the reporting period means the financial statement date. So you already have some information from your F3 and F7 exam, even F8. So you have some information because you did this standard over there. Events after the reporting period. And the number of the standard is IAS 10. First of all, let's look at the introduction of the standard and the purpose of the standard. Now, IAS 10 is all about dealing with the events which occurs after the reporting period. Now, let's draw a timeline in order to understand the concept. Say, for example, your year starts at 1st January, and obviously when it is starting at 1st January, it is going to end by 31st of December. This is the normal accounting year. Now, usually when the directors are finalizing the financial statements and the auditors are doing the audit, they take some time after the year end to finalize it. And then when the financial statements are, ready to publish, or they are published in the market, there's a difference between the year end and the financial statement issuance date. So this is the year end, which is the financial statement date, and this is the financial statement issuance date. So when they are finalizing the financial statement, usually they take some time in order to finalize it, because the auditors are doing the audit. They first of all do the audit, and then they just give the audit report to the management, and then the audit report along with the financial statements are being published in the market, floated in the market, or sent to the market. So there is a gap. There's a gap between the financial statement date and financial statement issuance date. So when the directors are preparing the financial statements and they're finalizing it and they're about to publish the financial statement, in this period, there may be some transactions. There may be some transaction which may have the linkage with the year end. So it's all about the accounting for those transactions which are occurring in this period. Now the accounting issue is whether to record or whether to adjust those transactions in this year or in the next year. So the financial statements are prepared as at the end of the reporting period. But often the accounts are not authorized by the directors until some months later, because they are just doing the work on them, they are finalizing it, audit is going on. During this time, events may take place within the entity that should be communicated to the shareholders. Now there are events which somehow have the connection with this year end. In this period, there may be events which may have the connection with this date. Now, the accounting issue is whether those events should be recorded in this year or in the next year. So IAS 10 deals with these type of events. IAS 10 describes the treatment for these type of events. IAS 10 events after the reporting period has two main objectives: to specify when an entity should adjust its financial statements for events that occur or become apparent after the reporting period, but before the financial statements are authorized for issue. Now that means there will be some events which has a strong connection with the year end, and those events will be recorded in this year. But there will be some events which will be adjusted in the next year, but those events may require a disclosure in the current year. So that means we have to look for the events which may require either the adjustment or the disclosure in the current year financial statements. So IAS 10 includes the requirement that the financial statements should disclose when the financial statements were authorized for issue and who gave the authorization as well. So this is the objective of the standard. We are going to identify the events which has occurred after the year end. That is why the name of the standard is events after the reporting period. Those events are occurred after the year end, but somehow they have a connection with the year end. Now the management needs to assess this thing, that whether those events required the adjustment or the disclosure in the current year financial statements. So this is actually a debate in IAS 10. This is the thing we'll be looking for. So now IAS 10 describes two types of events: adjusting events and non-adjusting events. Now you have done this thing so many times in your F3 exam, F7 exam, and F8 exam. First of all, events after the reporting period are those events both favorable and unfavorable. Now, what do we mean by the events which are favorable or unfavorable? Now, for example, if you look at the events such as restructuring. Now, restructuring is a positive activity. If you talk about, for example, litigation, now it depends whether we are doing the litigation or there is someone who is doing the litigation on us. Similarly, the inventory is being damaged. Similarly, there can be a natural catastrophe such as flood, earthquake, which can damage the premises or, for example, the inventory. So there can be anything. There can be either a change in the value of the foreign currency we have. There can be a litigation. There can be a damage in the inventory. There can be a natural catastrophe. So when you're talking about the events, these events can be both favorable and unfavorable that occur between the year end and the date on which the financial statements are authorized for issue. So this is the thing you need to understand, that if you want to understand the events after the reporting date, you need to see the timeline and then study this definition. Both favorable and unfavorable that occur between the year end. Year end means the financial statement date and the date on which the financial statements are authorized. That means financial statements issuance. So two types of events can be identified: adjusting events and non-adjusting events. Now, what do you think when you are reading the name adjusting events? Now, adjusting means that you will be recording those events in the current year financial statements. Because the name suggests adjusting events, that these events should be adjusted. Now, is there any logic of adjusting those events in the current year financial statements when these events are occurring after the year end? Do we have an evidence? Do we have a logic of adjusting these events in the current year financial statement? Yes, because the common sense is that why we are adjusting these events in the current year financial statement is that these events have a strong connection with the year end. There is an evidence at the year end. That is why we are adjusting these events in the current year financial statement. Now, what are the examples of adjusting events? We'll be looking at those examples shortly. Non-adjusting events, as the name suggests, as the name implies, we are not going to adjust these events in the financial statements, current year financial statements. So if we are not adjusting it, what we're going to do? We're going to disclose them in the current year financial statement. So you just go and look at the objective. That these, you see the timeline, these are the events which are occurring after the year end, but they may have a connection with the year end. Now we have to assess whether these events will be adjusted in the current year financial statements or they require the disclosure. Now we have sorted it out by saying that if that event has an evidence available at the year end, that is known as the adjusting event. Provide evidence of the condition that existed at the year end. And because it has a connection with the year end, so we're going to adjust that thing in the current year financial statements. And non-adjusting events, which is opposite to adjusting events, indicative of conditions that arose after the end of the reporting period. That means no evidence was available at the year end. So if no evidence is available, then that means these should not be adjusted in the current year financial statements, but should be disclosed. Now, why we are disclosing it? We are just disclosing it for shareholders so that they know that something is coming. Something is coming in the next year. So we are just increasing the transparency. We are talking about more openness. That is why we are giving the disclosures. So this is the adjusting and non-adjusting event. Now, first of all, we'll be talking about the accounting for adjusting events. Now, I have already explained it to you that these are the events which have the evidence at the year end, and that means there's a strong connection between there's a strong connection between the event and the year end. So you are going to adjust this event in the current year financial statements. So IAS 10 states that if an entity obtains information about an adjusting event after the reporting period, it should amend and update financial statements to allow for this new information. Now, why we are using the term amendment? Because till the year end, we have already prepared the financial statement. We have already prepared most of the financial statements. Almost they are finalized. And then there is the event which has the evidence at the year end. So that is why we are using the term amendment. Why we are using the term amendment? Because we have already prepared the financial statement at the year end. This event is coming after the year end. So sometimes we need to amend the financial statements which we have already prepared to include this information into it. An entity shall adjust the amounts recognized in its financial statements to reflect adjusting events after the reporting period. So there will be an adjustments. This might seem common sense. If the condition existed at the year end, it is reasonable to expect that the financial statements should recognize those conditions, even though the fact did not become known until later. Now, this is what I've already explained to you, that there's a logic behind that. When we are saying that this event has occurred after the year end, but this event has a connection with the year end, the evidence was available at the year end, that means this event belongs to this year, not to the next year. So you should record this event in the current year rather than in the next year. So we're going to make the adjustment. Now, let's have some examples. Now, the examples, first of all, the sale of inventory after the reporting date. This gives evidence about the net realizable value at the reporting date. This is something important to understand. Say for example, the year end is 31st December 20x8. Year end is 31st December 20x8. Now, by 5th January, you were just counting your inventory. On 5th January, you were counting your inventory, or you were having a look at your inventory, and you found that the inventory which was produced on 28th December is damaged. Now the cost of that inventory is 2 million, and net realizable value of this damaged inventory is 0.5 million. So your year end is 31st December 20x8. Now the event occurred after the year end on 5th January, that you were actually having a look at your inventory, you were sending the inventory to some customer, and then you just noticed that inventory which was produced on 28th December, before the year end, that means, is damaged. The cost of that inventory is 2 million and the NRV is 0.5 million. So we know that according to IAS 2, inventory should be recognized at lower of cost and NRV. But this might be a scenario that the management is thinking that because we have this information after the year end, and when we counted the inventory at year end, there was no such information. Now we have came to know regarding this. So this thing should be adjusted in the 20x9 rather than 20x8. But the standard says that because this inventory was produced at the year end, like 28th December, so this is an adjusting event. Now you should record it at lower of cost NRV in the 20x8. So what they are going to do, they are going to debit the profit or loss by 1.5 million because this is a loss, and credit inventory 1.5 million because they have to bring it to the NRV of 0.5 million. The bankruptcy of a customer after the reporting date. Now this is the special thing which is discussed under IAS 10. If a customer after the year end says that we are not going to pay you now, or the customer has gone bankrupt after the year end, this is an adjusting event because usually there are indicators that the customer is delaying the payment, they are struggling to pay. You have already created the allowance for that doubtful debt, which shows that actually the evidence was available at the year end regarding their struggling situation. So you are not going to say this thing that because the receivable has gone bankrupt after the year end, so we will be adjusting it in the next year, not the current year. So this is something important to understand, that IAS 10 specifically talks about the receivable which is getting bad after the year end, because it makes a sense that when you have created the allowance for that receivable, that means you are aware that they are struggling to pay. Similarly, we have third example, the discovery of frauds or errors. Now this shows that the financial statements are incorrect. So that means this is an adjusting event. And even when you talk about the frauds and errors in terms of IAS 8, like which talk about that the errors or the frauds, these should be adjusted retrospectively. So again, skipping that thing for right now, the discovery of frauds and errors, because they are related to the current year financial statements, even if you know after the year end, so that those should be adjusted in the current year financial statement, because it has some connection with IAS 8 as well, which states that these should be adjusted retrospectively, so that it seems that the fraud or error has not even occurred. Then you have the settlement or after the reporting period of a court case. Now, for example, you received a litigation by 29 December, and the decision of the case will be done after the year end. And you say because the decision will be done after the year end, so we'll be creating the provision in the next year. No, you have to create the provision in the current year because you have received the litigation, and if the outflow is probable, you have to record the provision now. So these are the examples of the events which has the evidence at the year end, and these are adjusting events, and these should be adjusted in the current year financial statements. Now we'll be talking about the non-adjusting events. Now the non-adjusting events means that there's no evidence at the year end which supports these events to be an adjusting. So when they are non-adjusting, we are not going to adjust it, and we'll be just providing the disclosures if these events are material. When you talk about the materiality, then an item is material if it can affect the decision of the user of the financial statements. Usually we do not have any specific percentage through which we can just identify whether this thing is material or not, but we have generally accepted guidelines. Generally accepted guidelines, and even we use those generally accepted guidelines in the audit as well. Like we have the criteria of profit, assets, and revenue. If an item is 5% or more of profit, 1% or more of assets, 0.5% or more of revenue, then we are going to call those events as material. But again, materiality can be anything. It can be quantitative, it can be qualitative. But in simple terms, material is something significant. Material is something which can affect the decision of the user of the financial statements. In terms of amount, we call it quantitative materiality. In terms of its value or the significance, importance, we call that thing as qualitative materiality. So non-adjusting events after the reporting period are treated differently. A non-adjusting events relates to condition that did not exist at the year end. So there is no evidence, such as natural disaster. Therefore, the financial statement must not be updated to include that event. We are not going to adjust it. IAS 10 states quite firmly, an entity shall not adjust the amount recognized in the financial statement to reflect non-adjusting event. There is no need to adjust that thing in the financial statement because that is a non-adjusting event. However, IAS 10 goes on to say that if a non-adjusting event is material, a failure by the entity to provide a disclosure about it could influence the economic decision of the user of the financial statement. That means if they are not giving the disclosure, that can affect the validity of the financial statements. So that means if the events are material, there should be a disclosure. There must be a disclosure. So what you are going to disclose, the nature of the event, what is the event, an estimate of its financial effect, how this event is going to affect the company or the organization in terms of value, in terms of monetary amount. So this is a non-adjusting event. Now you have examples. A major business combination after the reporting date or the disposal of a major subsidiary. Announcing a plan after the reporting date to discontinue an operation. Major purchases and disposal of assets. Destruction of assets by a fire because it's a natural event. Announcing or commencing a major restructuring. Large changes after the reporting date in a foreign exchange rates. Now, do we have a criteria of this thing? Like, first of all, starting with the last thing. I told you in the damage inventory example that the inventory was present at the year end. It was produced on 28th December. And they came to know on 5th January that the inventory has been damaged. But we said this is an adjusting event because the inventory was available at the year end. And that is why in the current year it should be recorded at lower of cost NRV. Now say for example, entity was having some foreign currency at year end. So foreign currency, say for example, $100,000. $100,000. And the functional currency of the entity, for example, is rupees. Now, the company is having $100,000 at the year end. At the year end, the rate was $1 equals to 155 rupees. Now, on 10th January, there was a major shift, and now $1 is equal to 170 rupees, for example. So there is a jump of 15 per dollar. When $100,000 multiplied by 15, this is a significant amount. And based on the inventory logic, inventory was present at the year end, and they came to know regarding its damage after the year end. But we said because the inventory was available at the year end, this is an adjusting event. Similarly, the foreign currency was present at the year end, and they came to know on 10th January that the value is significantly different. Now the management is keen to, just show the impact because it will boost their financial position, because they were having $100,000 and like it was 155, now it's 170. So it is going to boost their financial position. They are keen to record it. It's a favorable event. But the standard says it's a non-adjusting event. Now, why it is a non-adjusting event? Because the foreign currency is not under their control. They are not determining the value of the foreign currency. And IAS 21 has their own rules for it, that you are going to take the closing rate. Now, closing rate is the rate which was at 31st December, and that's fine. Now you are not going to change it, and that change is not even under your control. The inventory was produced on the year end, and it was actually damaged, but they came to know after the year end. So that was their issue. But now the foreign currency was different at the year end, and the change in the foreign currency is not under their control. That is why it is a non-adjusting event. All you can do is to give a good news to the shareholders that the dollar has grown up and you will be having a benefit from it. But you cannot financially record this amount in the financial statement. All you can do is to disclose it. Give them a news that something good is coming. Announcing or commencing a major restructuring. Now, what is restructuring? Restructuring is discussed in IAS 37. Now, if they are having a plan of restructuring, which they have announced after the year end, that means it's a non-adjusting event. Destruction of assets by a fire is a natural event. Similarly, if they have acquired some company after the year end, if they have disposed some company after the year end, again, this is a non-adjusting event, because every time the company has the plan to grow, like if someone is making a logic that because they were having a decision to acquire a company, this is an adjusting event. Every time the company has a plan to grow, and even if they were having a plan to acquire a company, they can change it after the year end. So this is a non-adjusting event. So when you have the non-adjusting events and these are material, so there will be only a disclosure rather than recording those transactions, adjusting those transactions in the current year financial statements. Similarly, what about the dividends? Now, every time the shareholders have the expectation that the directors will be announcing the dividend, every time they have the expectation, every shareholder has the expectation that there will be something coming from the company in the form of the dividends. And obviously, the dividends will be announced after the year end when the performance is being seen. So when you talk about the dividends, they are a non-adjusting thing. IAS 10 also contains specific provisions about proposed dividends and the going concern assumption. So if the equity dividends are declared after the end of the reporting period, they should not be recognized as a liability in the statement of financial position because they did not exist as an obligation at the year end. Every time the company has a plan to give the dividends to the shareholders, but they can change this plan. So there is no obligation at the year end because the dividend is at the discretion of the directors. They can change the plan. Dividend proposed after the reporting period should be disclosed, and that should not be recorded as a liability. So remember these things, these are important for the exams. Now you have a going concern issue. Now this is something important. But first of all, you need to remember the framework and what is going concern assumption. So the going concern assumption is that an entity is a going concern if they can continue for the foreseeable future. You have studied this thing so many times in your accounting papers. An entity is a going concern if they can continue for the foreseeable future. An entity is a going concern if they can continue for the foreseeable future. And according to IAS 1, these are 12 months from the reporting date. Now, say for example, their year end is 31st December 20x8, then that means they should be able to continue their business till 20x9. So these are 12 months from the reporting date. So if the entity is a going concern, now you have to see if the entity is a going concern. And the second case is they are not a going concern. Now, is a going concern means that they can continue for they can continue for a foreseeable future. So if the entity is a going concern, then financial statements should be prepared on going concern basis. And if they are not a going concern, then financial statements should be prepared on breakup basis. Now, going concern basis means usually preparing the financial statement including accruals, prepayments, carrying values, and breakup basis means that they won't be able to continue, so they have to record the realizable amounts such as fair values, NRVs, Now the thing, they are the amounts they are going to realize, actual amounts, no accruals, no prepayments. Now this was the introduction of the going concern. Now we are talking about what if there is something, there is a doubt over the going concern which came into the knowledge after the year end. There is exception to the rule that the financial statement reflect conditions at the reporting date. If after the reporting date the management decides to liquidate the entity or cease trading, that means they are not going to continue. Like for example, like 31st December is the year end, and they take the decision, for example, by 15th January that they are not going to continue. Now, the current year financial statement should not be prepared on going concern basis. They should be prepared on going concern basis because we are saying that an entity can make the financial statements on going concern basis if they can continue at, for at least 12 months from the reporting date. So if after some days of the year end they are deciding to close the business, they cannot make the current year financial statements on a going concern basis. They will be preparing it on the breakup basis. And what if they have some doubt regarding the going concern? They are not sure. Like currently they are a going concern, but there is a material uncertainty. Like say for example, a company is a profitable company, everything is going fine, but there's something going on in the legislation that government is actually taking some decision, and they may change, they may bring a new law, and the new law can threaten the existence of the company. Now that is a material uncertainty that should be disclosed. If entity is a going concern, right now they are a going concern, but there is a material uncertainty that can cast a significant doubt on their going concern, that should be disclosed. And if their assumption is wrong, that means they think that they are a going concern, but they are not, then the financial statement should be prepared on the breakup basis. So the entity should know this thing. According to IS1, they should have a clear knowledge about their going concern. If they are a going concern, they can continue for the foreseeable future, which is 12 months. Fine, they can prepare the financial statement on the going concern basis. If they are a going concern, but there is a material uncertainty, then they need to disclose it. And if they know they cannot continue as a going concern, then the financial statement should be prepared on the breakup basis. So this is something important to know. Now you have the disclosure. So an entity discloses the date when the financial statements were authorized for issue and who gave the authorization. If non-adjusting events occur after the reporting period and their material, they should be disclosed. And what you will be disclosing, the nature of the event and the estimate of its financial effect, which we have already discussed. Now you have an example. Delta is an entity that prepares financial statements to 31st March each year. So 31st March is the year end. During the year ended 31st March 2002, the following events occurred. At 31st March 2002, Delta was engaged in a legal dispute with the customer. So at year end, Delta was engaged in a legal dispute with the customer who alleged that Delta had supplied faulty products that caused the customer actual financial loss. The directors of Delta considered that the customer has a 75% chance of succeeding in this auction, and the likely outcome should the customer succeed is that the customer would be awarded damages of 1 million. All right, so we have to look at the percentages in order to determine the possibility, probability, and remoteness or virtual certainty. The directors of Delta further believed that the fault in the product was caused by the supply of the defective components by one of the Delta's suppliers. Delta has initiated legal action against the supplier and considered there is a 70% chance Delta will receive damages of 800,000 from the supplier. Now, hopefully you remember what we discussed in IAS 37, that inflow should only be recorded if it is virtually certain, and outflow, if there's an outflow which is probable, a provision should be booked for that. On April 20x2, a water leak at one of the Delta's warehouses damaged a consignment of the inventory. April 20x2 means after the year end, because their year end is 31st March. A water leak. A water leak. Should there be any evidence at the year end of the water leak? If they knew this thing, they would have actually fixed it. This is something, natural. The inventory had been manufactured prior to 31st March at a total cost of 800,000. The net realizable value of the inventory prior to damage was estimated at 9,60,000. So cost is 800,000, NRV is 9,60,000. Because of the damage, Delta was required to spend further 1,50,000 on repairing and repackaging the inventory. The inventory was sold on 15th May 2002 for proceeds of 900,000. Any adjustment of this event would be regarded by Delta as material. Discuss how these events would be reported in the financial statements. So now whenever you will be having a question on IAS 10, there will be a case study, obviously, because this is not F7, this is strategic business reporting. You will be having, although the standard is same, both in F7 and SPR, there's no change. All right. So under the principles of IAS 37, a provision should be made for the probable damages payable to a customer. The amount provided should be the amount Delta would rationally pay to settle the obligation at the end of the reporting period. Ignoring discounting, this is 1 million. This amount should be credited to the liabilities and debited to the profit or loss, which means the entry of the provisions, debit profit or loss, credit provisions. Under the principles of the potential amount receivable from the supplier, contingent assets should not be recognized but should be disclosed, because it is not virtually certain. There was only 70% chance. If it is more than 95%, then they would have recorded this thing as an asset. But right now they can just disclose it because this is probable. So this was the treatment of part A. And regarding part B, the event causing the damage to the inventory occurred after the year end. Under the principle of IAS 10, this is a non-adjusting event because this is a natural event. Non-adjusting events are not recognized but are disclosed if they are material. So this was all about IAS 10.